Hello Radhika. The first question which comes to us a lot of time now is 2018 till date has been very volatile, and equity investors are seeing this for the first time. What is your advice for these investors?
So let me step back a little bit about volatility. See, volatility is a reality, but it's also a very technical word. So let me tell investors a quick story that pertains to life. If you think about anything on a daily basis, if you think about your own life, it is very, very volatile on a daily basis. You deal with traffic, you get sick, you have problems at work, you fight with your spouse. If you think about your life on a yearly basis and you step back, it feels a little less volatile. And when you step back 5 years and think about your life, things usually look good. Markets are a little bit like that. So volatility is a reality, but it is a reality on a daily basis. I would advise investors to step back and just have a little long-term horizon, because when you look at equities over a 3-year, 5-year period, all the noise dies down and things look a lot calmer.
The second question which always comes up is the asset allocation part. Whenever markets fall or are volatile, should investor look at rejigging their asset allocation?
So I think it's a very relevant question, and I'll give you 2 points of view to this. One is that the greatest thing about asset allocation is, at a broad level, it should not change. It should not change whether you're in bull markets, it should not change whether you're in bear markets, because asset allocation is designed to suit your long-term needs. That said, there is a broad asset allocation. For markets like these, if markets have fallen materially, you can definitely look at small changes in your asset allocation. For instance, today, mid-caps have corrected substantially, so one can look at increasing perhaps a small portion of their mid-cap allocation today to take advantage of small corrections in the market.
Equity is said has been volatile, but also debt, if you see fixed income side, we have witnessed heightened volatility, be it recent downgrades or spike in yields. So how should investor approach while investing into funds? How they should look at credit risk or duration risk?
So before we talk about what funds, I want to make a point on risk in fixed income. Now, when investors invest in fixed income, often we don't talk about the kind of risk that there is in fixed income. At a very basic level, there are 2 kinds of risk in fixed income. One is the risk that comes out of duration, as you said. That is risk because of interest rate movement, and it is mark-to-market risk. If you're holding a bond for 3 years, over 3 years there will not be risk. Because interest rates move between those 3 years, there will be mark-to-market risk. The second is the risk that comes out of credit. That is a reality. Because there are different companies with different credit qualities, things like defaults can also happen, much as one would not like them to happen. If investors are investing today in volatile times and don't want these kind of risks, then they should invest in funds at a shorter end of the fixed income spectrum. Liquid funds, low duration funds, arbitrage funds. These funds typically carry less interest rate risk, less credit risk, and that's what we'd recommend investors look at. If they want to look at other packs in fixed income, they should be very cognizant of the kind of risks that they're taking.
Now the hottest topic in mutual fund has been over the last 2 years is around SIPs. Almost 1/3 investors have started their SIP in recent last 1 or 2 years, and most of these investors have seen negative or very low returns from these SIPs. What should they do today?
I think investors should remember 2 things. When they started SIPs, they started them with a goal. And usually the goal was very long term. I did an SIP for my child's education, I did an SIP for a marriage, I did an SIP for some long term goal I had. So don't lose sight of that long term goal, because things have been poor in the last 1 year. Secondly, SIPs take advantage of market volatility. So the fact that markets are down, actually you're going to be making monthly investments at lower values. So SIP investors should actually be happy about this, not get disheartened by the fact that their SIPs are down over the last 1 year.
That's right. So someone today who has a lump sum amount and wants to invest, SIPs are good of course, but if he wants to invest lump sum, which category of funds do you think is the right way to go forward?
See, I'm often asked this question, and I think I'm glad we are chatting about this. The MF industry has now created a very powerful construct called hybrid funds. Not every investor is ready for just equity and the volatility of equity. Not every investor wants the returns that you get from debt. If you're looking for something in the middle, and in today's environments where markets are volatile, I think the category of balanced advantage funds or dynamic asset allocation funds can be very powerful for investors. They have the ability to give you equity upside, yet they're not fully invested in equities, so they can give you downside protection. More importantly, dynamic asset allocation or balanced advantage funds shift between debt and equity depending on market conditions, so they can actually take advantage of volatile market conditions. And that question you asked about rebalancing your asset allocation, they do that automatically, so you don't need to do it as an investor.
So what should be the investment horizon if someone is investing in balanced advantage funds or equity savings fund in the hybrid space?
So I think for balanced advantage funds, investors should definitely look at a 3-year plus kind of horizon. For equities, we say 3 to 5 years, particularly on the mid-cap end. I think for balanced advantage funds, one should look at 3 years. For equity savings funds, one can narrow that a little bit because it's more conservative and look at something like 1 year or 18 months at the minimum.
And lastly, Radhika, what are your key 3 advice to investors in current volatile markets?
So it's firstly hard to narrow this down to 3, but here are the things I would say. One is that volatility is a reality. We live in a volatile, uncertain, complex, ambiguous world, and we will ahead of elections, political events, global developments. So embrace that volatility, don't get scared by it. The second is invest for your own goals. Today the mutual fund industry has enough products to meet every kind of investor need. And remember that your goals are your own goals. They are not your neighbor's goals, they are not your father's goals, they are not your friend's goals. Invest for your goals. And then the third, and if I had to just give one piece of advice, this is the one I would give. Seek good financial advice and seek a good financial advisor. In difficult times, your behavior determines the outcome of your investments, and having someone there to guide you on your goals, to guide you on being long term, to guide you on the right products is invaluable. So mutual fund sahi hai, market will be volatile, but advice bahut zaruri hai, and seek good financial advice.
Thank you, Radhika, for sharing your views.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.